What are the tax implications of owning a vacation home? Have you ever wondered how owning a vacation home affects your taxes? It's a topic that many real estate investors should understand. Let's break it down into manageable pieces. First, let's talk about mortgage interest and property tax deductions. You can usually deduct mortgage interest on your vacation home just like you do for your primary residence. However, there is a cap on the total mortgage debt eligible for this deduction. Currently, that cap is set at $750,000 for combined primary and secondary homes. Additionally, you can deduct property taxes on your vacation home, but keep in mind there is a limit of $10,000 per year for state and local taxes, which includes property taxes and income taxes. These deductions can help lower your taxable income, which is especially useful if you own multiple properties. Next, how you use the property plays a big role in tax treatment. If you use the home for personal enjoyment for more than 14 days a year or more than 10% of the days it is rented out, it is considered a personal residence. In this case, you can still deduct mortgage interest and property taxes, but rental losses are generally not deductible. On the other hand, if you rent out the home for more than 14 days a year and limit your personal use, it is treated as a rental property. This allows you to deduct rental-related expenses like maintenance, utilities, and depreciation, which can help reduce your taxable rental income. Speaking of depreciation, when the vacation home is rented, you can depreciate the property over 27.5 years. This means you can take a non-cash deduction that lowers your taxable rental income. However, when you sell the property, you will need to recapture that depreciation, which could be taxed at a rate of up to 25%. This recapture can increase your tax bill when you sell. Now let's discuss capital gains tax. When you sell your vacation home, you will face capital gains tax on any profit. The rate you pay depends on how long you have owned the property. If you have owned it for more than 1 year, you will benefit from long-term capital gains tax rates, which can be 0%, 15%, or 20% based on your income bracket. If you sell within a year of purchase, you will pay short-term capital gains tax, which is usually taxed as ordinary income. Another consideration is the net investment income tax. If your income exceeds certain thresholds, you may owe an additional 3.8% tax on rental income and capital gains from your vacation home. For those looking to defer capital gains taxes, a 103,100 exchange can be a smart strategy. This allows you to reinvest the proceeds from the sale of your vacation home into another investment property, deferring taxes until the new property is sold. Lastly, if you actively manage your rental property, you may be able to deduct losses against other income. However, this can also increase your risk of being audited, as the Internal Revenue Service closely examines vacation homes used as rentals, especially when owners claim significant losses. Owning a vacation home can offer tax benefits like mortgage interest and property tax deductions, along with expense deductions if rented out. However, it is essential to track personal versus rental use, understand depreciation recapture, and plan for capital gains taxes when selling. Consulting with a tax professional who understands real estate can help you navigate these tax implications effectively.